Welcome to Lesson 20, Chart Basics Lesson 6. Today we learn moving averages, one of the tools traders everywhere reach for most often. We'll cover 4 things. 1. What a moving average is. 2. Short versus long averages. 3. How to use them for trend and support/resistance. And 4. Golden crosses and death crosses. The core idea is simple. Take the daily ups and downs, average them out, and draw a clean line that shows only the bigger flow. That line is the moving average. Look at the Bitcoin daily chart on your screen. By the end of this lesson, you'll be able to read those lines the same way traders watch them on the S&P 500 or not. Here's how you build one. Add up the closing prices, the last price of each day for the last 20 days. Divide by 20, plot that point, and connect those points day after day into a line. Concrete example, say a stock closed at $100, $90, and $110 over 3 days. The 3-day average is open parenthesis 100 plus 90 plus 110 close parenthesis divided by 3 equals $100. A moving average is just those averages strung together. Every day a new price comes in, and the oldest price drops out. That's why it keeps moving. Hence the name moving average. On the Bitcoin daily chart in front of you, the light blue line is a moving average. The candles jump up and down. That line glides smoothly underneath. That's noise removal, showing only the core direction. Same idea as looking at a week's average temperature. Daily weather wiggles, but the season's trend becomes obvious. A 20-day moving average moves fast. On this Bitcoin daily chart, it hugs the candles closely. A short window means each new price hits the average right away. A 100-day moving average is gentler. On the same chart, it drifts slowly. With 100 days in the mix, 1 day's move barely matters. You mostly see the bigger direction. Think of it this way. A 20-day average is like grading the last 20 books you read. Recent books weigh a lot. A 100-day average is like grading everything you've read for the past year. One new book barely shifts the score. Pros usually watch both together. Short average above the long one reads as bullish, below reads as bearish. When the short one punches up through the long one, that's often a trend shift signal. The same logic traders apply on the S&P 500 when the Fed's rate path is shifting risk appetite. Which periods people use varies. Common ones include 20, 50, 100, and 200 days. What matters most is testing which links fit your own style and time horizon.
Look at the Bitcoin daily now.
Candles above the moving average point to an uptrend, below point to a downtrend. Whether the average itself is sloping up or down matters too. One simple rule covers a lot. Price above the average equals bullish. Price below equals bearish. Plenty of traders treat that as their baseline on Bitcoin, on Apple, or on the Nasdaq. Historically, in strong bull stretches, Tesla's 2021 run, Bitcoin's 2017 rally, price spent long stretches above the average. In bear stretches, the 2022 crypto downturn, and risk-off months when the Fed was hiking hard, price spent more time below it. There's an important limit, though. Because a moving average is built from past prices, the signal can lag. The trend may already have turned for a few days before the line itself rolls over. So don't decide from the average alone. Confirm with volume, candle shape, and support/resistance. That's much safer. A moving average isn't just a trend line. It often becomes a place where people actually buy or sell.
Why?
Traders all over the world are watching the same line. Look closely at the Bitcoin daily price rallies, then pulls back toward the average and often bounces there for a bit. Near that average sits a buyer interest zone from people who bought cheaper. When price comes back, more of them see a good chance and step in. That's called getting support at the moving average. Check it yourself on the chart. In a downtrend, the same average can act as resistance. Price climbs into the line and then falls again. People who bought higher use that area to cut losses or take profits. The more traders watching that line, the stronger the support/resistance effect gets, the same crowd dynamic you see around widely watched levels on the S&P 500. On the Bitcoin daily, watch the orange line, 20-day, and the blue line, 100-day. When the orange line crosses up through the blue from below, that moment is a golden cross, read as a strong bullish signal. When the orange line crosses down through the blue from above, that's a death cross, a bearish signal. Both are crystal clear visual cues, which is why so many traders lean on them. Historically, golden crosses showed up often in strong bull markets like Bitcoin's 2017 rally, and death crosses repeated through bear stretches like late 2018. The same pattern traders track on major U.S. indexes during Fed-driven risk-on and risk-off phases. Again, there's a limit. By the time a golden cross prints, price has often already climbed a lot. The signal can be late. When social media is screaming golden cross, a lot of traders are already in. So don't trade the cross alone. Combine it with volume, chart patterns, and other indicators. That's far safer. Lesson 20, Chart Basics Lesson 6, Wrap Up. 1. A moving average is the daily chain of recent end-day closing averages. It's a trend line with the noise stripped out. 2. A short average, 20-day, tracks recent changes well. A long average, 100-day, shows the bigger direction. Together, bullish versus bearish gets much clearer. 3. In practice, you use them for trend calls, support/resistance zones, and golden/death cross signals, and the key is always reading them alongside other indicators or volume. Next up, Lesson 21 is the last of T1. We'll quickly tour major indicators, RSI, MACD, Bollinger Bands, and wrap up the chart basics track. If this helped, please subscribe and hit like. I'll answer comment questions carefully. One important disclaimer: this lesson is for education only and is not investment advice. You are responsible for every trade you make.